Talks. All right, going live.
Deal.
Hello, everybody. Welcome to TraderMerlin Show. It is your Wednesday edition. Like Led Zeppelin said, I'm going to squeeze that lemon till the juice runs down my leg. It's squeeze week here on TraderMerlin. Yesterday, we talked about the bond market squeeze. Today, we're talking about gamma squeezes. Hello, everybody. Thank you for joining us today. I hope you are ready for a good one. I see we got a pretty big group with us as well, so happy hump day. Our guest is no stranger to the program. It's going to be none other than Mr. Corey Lane, joining us from sunny Southern California of TradersArmy. How you doing, Corey?
What up, Merlin? How are you, brother?
I'm fantastic. Are you ready for squeeze week?
Squeeze week. When you said squeeze week, I'm like, I got to get on some of this.
We've got Shark Week, and I think now we'll just do Squeeze Week. It seems to be, I'm going to have to change tomorrow's show just to accommodate the squeeze aspect of it.
I love it. I love it.
I'm going to go first to a listener question that came through, because this is what spurred the whole talk track and the thought of doing a squeeze show today. It is from Tim. Tim says, I heard talk on CNBC about a gamma squeeze with Gamestop stock. What is that? All right, we know that Greeks are involved with trading, but there's specific things like a gamma squeeze, and maybe you can walk us through the basics of it and how it works.
Yeah, this is actually gives me an opportunity to really geek out on some of this stuff. So I love this stuff. So yeah, it deals with options Greeks, certainly, which is to some people a really complex topic, but it doesn't really have to be. But of all the Greeks, most people tend to focus more so on delta because it helps them understand how much they can make or lose on a position. It helps them understand the probability of that option expiring in the money. And the thing about GameStop is, and really GameStop, AMC, a lot of the stocks that really got caught up in this. And Merlin, I'm going to share a screen with you if that's okay.
Yep, absolutely.
All right, it's probably the best way to do this because I got some drawing to do, and don't make fun of my art.
Oh, trust me, my audience knows how incapable I am of drawing, so you'll probably be a breath of fresh air for them.
Well, and I'm going to try it with my new Wacom tablet and my little pen here, so we'll see how it goes. But
good luck with that. I've struggled with mine.
Well, yeah, you feel free to grade me on this at the end of my test. So, with such a high short interest on GameStop, it was very much thought that, hey, man, this stock is not going to survive. So one of the strategies that a lot of option traders will implement when they don't think the stock is going to rally very sharply or go anywhere at all to the upside is they'll sell call options. Now, I'm not a huge fan of selling naked call options, but that doesn't stop people from doing it. Selling naked calls is an obligation to sell stock that you don't even own yet.
Yeah.
And so what happens is if you sell a call, say at this, $49 or $50 area, and then all of a sudden the stock starts to rip above 49 or 50, just as an example strike price, you're obligated to sell the stock for $50. And if it rallies to 400, then you have to go buy it on the market at 400 just to deliver it to somebody else for 50. And that could create an infinite risk environment. And so obviously that's why I don't generally promote selling naked calls.
Mm-hmm.
I'd rather have a call spread than anything else. But people out there selling naked calls to get a bunch of premium in thinking, hey, this stock is not going to rally above 49. Look how crappy this stock is and the fundamentals. This thing's going to zero. Short interest is through the roof. So we focus on selling calls. Now, the thing about selling calls is you have an obligation to sell stock you don't own. So when you sell a call spread, by the way, how's the writing so far? Can you see that come through? Look at that.
Where's it at?
Well, did I share my screen with you?
I see your chart. I see your chart. No, I don't see your drawing skills yet.
You don't see my drawing skills. Hang on a second. What screen am I sharing?
You're sharing your platform.
Is that all I'm sharing?
Yep.
I wanted to share the entire desktop.
Yeah, I think it'll just pick one screen for this.
Oh, it's one at a time?
Yeah. So I think you just drag it over there and it'll probably work.
Well, let's try that.
No, there you go. Yep, now we got it.
I wrote the word negative call. That's for selling a call. You can see all that, right?
Yep, looks good.
Fantastic, perfect. So a call option, when you look at delta as a visual representation, a delta looks like this. right?
Mm-hmm.
And that's the delta curve, which basically means right smack in the middle of this curve, we know that delta can't be any smaller than 0, and we know that delta can't be any greater than 1. And we know that at the money, we've got a delta of about 50. And if I'm talking over your head from an option standpoint, if you're brand new to this might be a little Greek, pun intended.
Mm-hmm.
But this helps us understand if the stock price goes up, how much that call will change in value per $1 move. If the stock goes down, how much that call will change in value as the stock price goes down. And so that's primarily how people use this. And so if you're selling something that is out of the money, you're selling an option that has a lower delta. Selling something in the money has a higher delta. So most are going to go out there and sell something out of the money, which means they have a very low delta. Let's just call this a 25 delta. Very low sensitivity to the stock price moving, very high probability that option expires worthless because it represents, at least at that one point in time, a 25% chance that that option is in the money at expiration. So 75% chance that option expires worthless.
Right.
And somebody who's selling that call says, I want a 75% chance of keeping that premium. So selling a deep out of the money call makes sense to them. Well, here's what happens when the stock starts to go up, is that delta starts to get bigger and bigger and bigger. And so what happens to the rate at which this person is losing money is the rate at which they're losing money accelerates. Now, what causes this delta to increase, and you can see that it's not a static number and it doesn't change at a linear rate. What happens is this secondary Greek, known as gamma, kicks in, which is a bell curve shape when you look at this visually. I'm not quite sure that that's a bell curve, but close enough.
Pretty
right?
close, pretty close.
Pretty close. So gamma, which tells the delta, which tells us how much the delta is expected to change in value. So this is gamma down here, and this is delta up here. They work together, right? So gamma tells delta how much it's going to change in value as the stock price goes up or down. And so if the stock price is going up, that's not good for a short call seller. The speed at which that delta is increasing in value is directly correlated to gamma. And what happens is once that option becomes at the money, and even worse, goes in the money, now the short call seller is on the hook for potentially being assigned on that short call. Now they have to come up with the stock, go buy it for whatever the price is, and deliver it for that lower price. And so in order to remove that risk, what they have to do is either buy back the short call, so remove that short call position altogether.
And take a loss.
And take a loss. And they would probably lose quite a bit because they sold deep out of the money, and now they're taking a big loss instantaneously the moment they buy back that call.
Yep.
Or another thing that they can do, and this is exactly what occurred in GameStop, AMC, and you name it, all of them, is the massive amount of short call interest. One way to go ahead and offset risk without actually closing the call is to buy an equal amount of shares of the stock itself. So to go out, if you have a 50 delta, right, because you sold a call at 25 and now it's a 50 and it's going in the money, that person could go out and buy 50 shares of the stock. And if they buy 50 shares of the stock, this would give them positive 50 deltas on the stock, negative 50 deltas on the option, and it would zero out their delta. And when you have zero delta, that means you can make or lose zero money. And so instead of just closing the call out for a loss, what these massive, short call sellers did is they went out and bought millions and millions of shares of stock in order to hedge the risk on the short call, which created enormous demand and caused the price of GameStop to rally sharply, which thank God they did actually buy those shares, because otherwise they would have lost just an ungodly amount of money selling those naked calls. So thank goodness they did buy those shares when they did. But ultimately, that's what created the squeeze as it relates to options.
Right. Now that you mentioned earlier, just so we're clear, that the 0.5 is basically you could it tells you kind of how many shares you would need to buy to cover that options position, correct?
Yeah. Yes.
So that number was changing rapidly, and it's not fixed. That the curve is shifting there. And what people are missing out here is that as this thing went parabolic, as GameStop went straight up, you had the perfect storm. And you can keep your screen there. I'm just going to show them GameStop's chart here real quick. Here's the chart of GameStop, and let's assume that you're one of these big institutions, could be a market maker, could be a hedge fund, could be you or me, and you're selling naked calls. You look at this chart here, it went from $20 to 40 and then kind of hesitates there. And you're probably thinking, there's no way in hell this thing's going to 100. I can sell a naked call. I can collect a bunch of premium because it's not going to go to 100. There's just no way. Then all of a sudden the next day, you see it jump up to 75 and you're like, oh shit. I'm in trouble now. So at this point, what happens is these guys are going out and buying shares just to offset some of the risk. They're not out of the money yet, or in the money yet. They're still potentially going to get there. Next day, it rallies up to over 150. Now all of a sudden, these guys are losing significantly on those call options. And as Corey said, they could immediately go out and cover those call options and take a huge loss there, or offset that risk by buying the shares themselves. So what happened is, you had the short squeeze anyway. Remove options altogether and just say you had all these shares, 138% of float was short, and by price moving up, it forced these people to cover their short position. Now you combine on top of that people using derivatives, which is you use less capital and you can control more. To me, that's an even bigger factor here, right? That's a much bigger piece where you have buying pressure come in and vault price to the upside here and really crush price. To me, this is the pain point. And it didn't stop there. All of a sudden, it jumps up the next day to 350. So anybody who sold naked calls here is absolutely getting hosed. It was just absolutely brutal. So there you go. I just wanted to show that graphic.
I love that. Yeah, that's a great graphic. And I was looking up, I saw that there was an answer, a question in the chat box about if gamma affects the rate of delta, then what affects gamma? Well, there are third or tertiary Greeks that go into what affects gamma, what affects theta, what affects all the other Greeks. I've not studied too deeply that stuff, primarily because that stuff's not going to make you or cost you money. But if you want to really geek out on it, just Google second order and third order Greeks, and you can go to town. There's like 26 different Greeks if you really want to study the Black-Scholes formula, right?
I struggle with like 3 or 4. Come on, man.
Yeah, but it's a great question. I mean, the first time I taught class, an options class in San Jose, California, where all the biggest geeks, and I say this in a loving and endearing way, where all the biggest geeks in the world tend to live because of the tech central there. These guys were asking questions that are just off the charts. I'm like, I have no idea where that question even came from. I have no idea the answer to that question, but let's go find it together. So. Right. I saw the question. I actually just Googled it. I tried to find the third order Greek that affects gamma. I couldn't find it fast enough, but have some fun with it if you want. But yeah, coming back to this screen here, as the price kept rising, that Greek required them to buy even more shares as prices went against them. And that was just a beautiful combination of the short sellers of the stock having to buy back their shares, and the short sellers of the calls having to buy more stock to offset their risk. It was just a beautiful, perfect storm. It was amazing to watch.
And you don't see these all the time. I mean, I think now in the past, let's say, few months, we're starting to see a lot more of them simply because of Wall Street Bets and these Reddit groups, which are kind of making it. I'm not going to say the soup du jour, but all of a sudden they're realizing that very quickly they can move this market up. And I mean, what they're doing is they'll go out, and the retail guys will go out and buy a bunch of out of the money calls, and then collectively jump on, buy as much of the share price as they can, and effectively you trigger the short squeeze, and then at a certain point you trigger the gamma squeeze, and you make that perfect storm. You'll probably see more of this. One of the things that I've been following has been the companies with short interest, and you guys might remember. Right as the GameStop thing happened, I went to pulled up a list and showed you the most heavily shorted stocks out there, and there was GameStop at 138%. I think there was like 4 or 5 others that were like 80 or 90%. Now the highest shorted security out there is only 41%. So we've fixed that inefficiency in the marketplace, but it will probably happen again and again and again simply because people have exploited the short squeeze thing. It's popular, and gamma squeezes are not going to go away.
No, they happen, but this was just a moment in time.
Yeah.
It was a cool thing to be a part of and to watch. But
Can say we're a part of history, right?
I guess for a minute.
All right. This isn't something that you're actively out looking for, are you? You're still sharing your drawing board over here, so you can cut you back to you. We get your beautiful mug on camera again.
I can stop sharing screen now.
So you're not actively looking for any, when you're analyzing trades, you're not thinking, hey, okay, I'm setting, this looks like a gamma squeeze, see if I can capitalize on it.
I am not. No, I'm not. No.
All right, cool. If you guys have questions on gamma squeeze, let me know what they are. I know there's probably a lot of people going, that was way over my head, but it's a very timely topic, and it's certainly something that's happening as we speak in the marketplace. You had it happen yesterday with Rocket, right? RKT. That stock was just vaulting yesterday. I didn't watch it today. Did we continue on or we crashed back? Oh, we came crashing back down. This typically happens. Here's Rocket yesterday, but this is another example of a short squeeze. You see the massive volume on there, but anybody who sold naked calls on Rocket was getting hammered, and they had to go out and buy those shares to cover or take huge losses by covering the options. So, yeah, there you go, Okano, like Rocket. All right. Well, cool. If there are any questions on gamma squeeze, you feel free to send them on in. I will do my best to move on and ask other topical questions as I had come in yesterday. Specifically, Jeff. Jeff sent in a couple questions for us. The first one is pretty simple. It says, if selling cash secured put trades, let me repeat that all over again. If selling cash secured puts trade turn terribly against him, when does he pull the plug? Meaning anybody who's selling a cash secured put, when do you get out? Let's say 2 weeks out, you sell a 125 on Apple. Okay, you sell puts on Apple. Today it's trading at 122. Do you hang in there, or you simply don't mind owning it, or when do you get out on those?
What was the strike you talked about?
I think it's just an example. Let's say you got 2 weeks out, you got 125 put, and it's currently trading at 122.
Okay, so when I'm looking at selling cash secured puts, or I'm teaching someone about cash secured puts, the primary focus when you initiate the trade is to sell something that's below current price. If the stock were trading for 130 and you were willing to own it at 125, you're selling the out of the money put option. And I always say to my students, you have to know in advance, before you even place the trade, because this has to deal with position sizing, if the price were to get to 125, what would you be willing to do? Are you actually willing to own the stock at 125? And sometimes the answer is yes. If the answer is no, then the moment that you start managing that position is the moment it goes below 125. Because the moment that thing goes below 125, the closer you get to expiration, the more possible it becomes that you become assigned, and now you're under financial obligation to own the stock at 125. So if you're willing to own the stock at 125, then you can hold on to that position a little lower. But then this is the question I always get to is, where do I bail? Right, so the question he has, where do I bail? And I say, well, where's your stop loss? And they say, well, I don't have one. And I say, okay, well, if you're obligated to own the stock at 125, where would you have your stop loss if you had owned it at 125? That's the place that you start to actually unwind it, bail, or hedge. Because I think everybody's comfortable owning the stock. Everybody who comes in and says, I'm selling this cash secured put because I'm willing to own the stock at X price. However, if the price keeps dropping below my demand area or support area, well, at that point, I'm no longer willing to own the stock. So therefore, you should not be willing to still be short the puts at that price. And so if the stock's at 122 and it's still sitting in an area where it makes sense for you to still own it, then there's nothing for you to do right now. But if it drops below your support area, that's the point at which you hedge or just remove the short put altogether.
Yeah, for the ones that I'm doing, generally, I sell puts 30 days out or less. Obviously, you want to have less time possible, but usually it's at a level where I'm saying I don't want to own it. And I've had a few experiences, Jeff, where let's say in this example, you sold the 125 and it ends up dropping down to 122, but it still have 2 weeks expiration. I was comfortable owning at 125, so I'm okay with that. Now, what will end up what happened a few times for me is it actually rallies back up, and by the time it gets to expiration day, it's trading at 126 or 129 or something higher than the strike, and I never get executed. So you don't always get executed just because it's below that strike price, right? It might take some time. a lot of people are using other strategies, which they're going to ride all the way out to expiration, some spreads or something. So they're not going to just be, because it gets below 125, they're not going to exercise their option immediately. So I tend to hold on to mine. That's just one of the risks of it. But again, I'm selling those with the intent of I'm okay owning this at a specific level on the price chart.
Right. And you may look at that and say, well, if it keeps going below 120, at that point, I'm not willing to own it at 125 anymore, or something like that, right?
Yep.
And so that's where, if it goes below 120, I'd say that's where you close the puts, because sure, as long as it stays between 125 and 120, you're willing to own it. If it goes below 120, I'm out. And that's just an arbitrary number, but you'd pull your stop loss off of the actual chart itself.
Right. In a situation like we've had over the past couple weeks where, I don't know if I told you this, but I was, when the GameStop main heyday hit, I bought some puts. I went straight out and bought puts on it. And I bought them when they were at 350. And I forgot, I think my strike price might have been actually 180 on it. And I'm thinking, that's 50% drop. Great, right?
Yeah.
I closed those when it reached 90, and I only made 35% on it. Obviously, because the premiums were so unbelievably inflated. You're in just a very bizarre market environment. Is there a way, in your current market, we talked about yesterday, and some people were talking about spreads on this, where instead of just buying an option on something like that where it's just so inflated, would a spread help offset some of that premium spike and not subject me to such bad rate of return?
Yeah, 100%. To me, anytime volatility is inflated like that, the spread is the only way to go. Because as you did, you bought a put that was grossly overpriced. And, there's profit potential on just buying a put all the way to GameStop going to zero. But I don't think we anticipated GameStop going to zero. You just expected it to go down, right? And so the problem is GameStop did go down. But then if volatility goes down with it, then you grossly overpaid for that option. But what if you had set up the situation where you bought the same put, but then, which was grossly overpriced, but then you sold another put against it that was also grossly overpriced? Mm-hmm. Now you're offsetting your overall pricing, meaning you're not grossly overpaying for anything because you bought something overpriced and you sold something overpriced. But while you're still maintaining a delta that allows you to make money on the stock dropping, you can reduce pretty much most of your volatility exposure, which reduces your cost, reduces your risk of volatility dropping, which is what basically happened to your option. And then you could hold on to that trade for longer too, because your theta, your time decay, is not nearly as affected when you're in a spread versus just buying the puts. Yeah. So definitely a vertical debit spread is going to help negate most of, not all of, but most of that volatility risk, which is what you experience.
Yeah. Yeah, no, I definitely experienced it. It was more for fun. It's not like I didn't buy a bunch. It was about one just for giggles. But, you're looking at it going, man, this thing fell over 50%. I think I'd make more than a 35% rate of return. But, hey, that's what I was stuck with.
Yep.
ML in here says, can Corey explain skew too? I don't know that one.
What kind of skew you talking about?
I'm not sure.
Skew?
I don't know. It just says, can you explain skew? All right, let's go to another one. Question for Corey. Leap options. What are your thoughts? Are you a Leap fan?
I'm more of a Leap fan if I'm looking to hedge something. Generally speaking, if I'm looking to offset risk in a whole portfolio, I like 9 month, options, 1 year options, kind of an insurance policy. It's been years since I bought a Leap option, and I definitely don't sell Leap options. But Leap options are like any other option. They just have longer dates to them before they expire, which means your time decay is lower. So the effective time is not impacting that long-term option quite as much. The exposure to volatility is significantly greater on a Leap. Because, the old saying, given enough time, anything is possible.
Right.
If you have a long-dated option, given a year, then volatility could be a lot lower or a lot higher 1 year from now or any time in between. And so the vega, which is the Greek that is associated with implied volatility changes, is significantly higher on Leaps. So I can tell you that the only time I would even consider buying a Leap, it would really need to be in an extremely low volatility environment. And I would have to have a long-term outlook on that particular market, whatever it is. So I like them just fine, given the right environment. But you have to understand the mechanics of a Leap and how that differs from the mechanics of, say, a 1 or 2 month option.
Yeah. Well, you're also much more of an active income kind of generation using spreads. And I think that's your sweet spot, right?
Right. But you can set up spreads using leaps also. Like, for instance, I don't love the name poor man's covered call, but it's kind of a way if you wanted to, instead of buying, Apple for $120 a share, you could buy an Apple leap, which goes out 9 months to a year and pay a fraction of the price on a long-term call and then sell short-term calls against it. It's called a diagonal calendar spread. Mm-hmm. So you could do that, and there's a reason for that short-term income perspective of selling calls, but without having the cost of owning the stock outright. But again, the volatility environment is critical to buy in the right environment, because the whole trade could go against you if you buy in too high of a volatility environment.
Right. All right, ML added a little bit of clarity. He says volatility skew, and how can we benefit from it?
Yeah, that's what I figured they were talking about. And the skew is just the difference between long-term volatility and short-term volatility. For instance, and I don't have an actual example right now because I wasn't prepared for it. But if you were to look at each option expiration month, right? I use Thinkorswim. So can I share my screen one more time?
Yeah, whenever you want.
All right. I'll share this screen, and if I go under, look at an Apple option chain, for instance, and this is probably not a good example because I wasn't prepared with an example. But if you look at the far right-hand side of an option chain, you can see different percentage amounts, right? The very first March 5th expiration has 42%, 42.66%. Well, what is that? That's the expected volatility for that particular window of time. And so this is implied volatility off to the right. And so occasionally, not always, but occasionally you can see a big discrepancy between short-term volatility and long-term volatility. And especially if you see long-term volatility very low, but short-term volatility very high, one of the ways you can take advantage of that is to buy that long-term low volatility option and sell a really expensive high volatility short-term option. And now you're paying a low premium for something long-term and receiving a high premium short-term. There's different ways to do that. You could reverse that if volatility were really low in the front month and really high in the back month. But it's just, but when taking advantage of volatility skews, you're absolutely now in the world of spread trading, buying one, selling against that. Right. It's pretty neat stuff, though.
Yeah, absolutely. All right, let me see. One last question here, then we'll talk about some of the things you got going on. Let's see. Jeff got another one. We've had a couple guests on the program that specifically trade, one asset class, in particular the SPX, because you get the 3 times a week expiration. Jeff says, does Corey trade credit spreads on the SPX, and what strategy do you use?
I do. And I use the same strategy that probably everybody's talking about today. I've used it for years, right? Iron condors and credit spreads on the SPX. The only difference is when I first started doing them 12 years ago, they did not even have weekly expiration options. We had to do them for the month. And I was so excited when they had weekly expirations. And now that we have daily, yeah, I definitely try to find opportunity Monday, Wednesday, Friday to sell credit spreads. Sometimes I get into the Iron Condor, which is 2 credit spreads on the same stock at the same time, or SPX at the same time. But I was just talking to one of my members, my TradersArmy members. Literally, you were calling as I was finishing my mentoring session. And we just talked about the SPX. And while the SPX is a good trade, it's not my bread and butter. It's not my go-to all the time where I have to do some sort of credit spread on the SPX every Monday, Wednesday, Friday. Some people do that. That's their bread and butter. But to me, the SPX is sort of icing on the cake. So things that I look for that are very specific to any credit spread is the SPX has $5 wide spreads, right? $5 wide.
Yep.
So I know that I'm going to be buying an option and selling an option that are contiguous to one another. So I'm going to have a $5 wide spread for my credit spread. And to make the risk reward worth it, I have to receive at least 15% credit relative to the spread. So at a $5 spread, I need to see 75 cents collective credit to even think about making that trade. And the reason I've come to that number, 15% or 75 cents on a $5 spread, is I'm not willing to risk more than twice what I stand to make in any credit spread situation. I'll risk twice what I stand to make, because the odds of winning are, generally between 75 and 80%, win rate. And I'm willing to risk twice what I stand to make. But anytime you get above twice what you stand to make, I know people out there who are just really dangerous at this.
Mm-hmm.
They'll collect 25, 35, 45 cents. And I know that they're risking 5, 6, 7 times what they stand to make. And the reason this is so popular right now is because the market's not as volatile as it can be. And I got burned on this back in 2008 when I was not prepared for the volatility really that we saw in '08. And I had multiple credit spreads, iron condors, go against me at once. I had 4 iron condors go against me at once. And that wiped out, I'm not shitting you, Merlin, it wiped out the last 4 months of profits.
Yeah.
And I was like, what in the hell? Like, I can't afford this. What the hell just happened? And it's because I was not paying attention to risk relative to reward. I was just focusing on probability. And so I made it a rule at that point that I needed to actually look at what is a good risk-reward relationship for something like this relative to an actual win-loss percentage expectancy. And I came up with 2 to 1 is my max. I'm willing to risk 2 to make 1. And to get to that point, I need to get at least 15% return on the spread, or I don't make the trade. Right. So I can't say that I make a trade on the SPX every Monday, Wednesday, and Friday, but I show up and I look for one, and I can oftentimes find one, but not every time.
For me, the important part there, you talk about 2 to 1. I want to create a distinction here because anybody who's been through most of OTA's content is going to be saying, you want to have 3 to 1 reward risk ratio. That's generally when trading something like futures, Forex, equities. With options, I think it's a little bit different because what Corey's talking about is the trades he's looking to take have such a high probability of working. And I think that's where you learn your Greeks and you say, okay, I got a 0.15. I've got, an 85% chance of this working in my favor. While the profit potential isn't huge, I'm risking 2 to 1 because I know that there's a very good chance of this working out. And to me, that's a very different dynamic than you would get in an equity market.
1,000,000%. Because in an equity market, you have to be right on direction to make money.
Yeah.
And there's a lower probability of that occurring. Therefore, the risk-reward relationship has to be, I'm willing to risk 1 to make 2 or 3, but on a non-directional way out of the money credit spread, it's a different dynamic, different expectancy. So therefore, you can have a different risk-reward relationship.
Yep. Thomasina asked, does Corey do mentoring one-on-one?
I do.
You do? Wow.
I do. Yeah, you can find out more about that at TradersArmy. So I do that.
Talking about TradersArmy, I know that you've got some activity going on tomorrow, which I think people might be interested in.
Man, it's going to be fun tomorrow. We've ever since COVID started last year, we started this to get people kind of give something to do other than play video games and watch TV all day. Is we started doing online trader summits, which are like these Vegas summits and things like that you could do. And we started doing them online. And we'll bring in guests from different, friends of ours who are full-time traders, mentors, educators, and people from different brokerage houses. We've been doing these. This is our 4th one that we're doing, and we're doing it tomorrow. Can I post in the chat box?
I think you can.
Link they want to register?
I think you can. I don't know if it'll allow you to do that, but I think you can. If not, I can do it. I brought it up here. If you go to TradersArmy.com, right on the front page, there's I just clicked the link because you have to click one link to get to it. But you click on Learn, and the top one there says Trader Summit. So if you click there, there's your registration for free, and that gets you all the info you need to know at TradersArmy.com.
Yeah, it's going to be great, man. We've got some cool people coming that we haven't exposed to people in a while, and ever. We try to have different people every time. The last one I think we had we've had Sam Evans on, we've had Brandon Wendell on there, we've had people that you guys never heard of, and so this time we're bringing on some people that you probably don't know. We're bringing on the Senior VP of Infinity Futures to talk about his futures trading tactic, probably talk about the platform a little bit. We've got a guy who is the senior developer over at a brokerage firm called TradeStation, who's got just a shit ton of options volume going through there, and they've got an amazing TradeHawk platform, which is really interesting. It's very innovative, not just from a platform standpoint, because they're about one of the most advanced platforms that I have found for options. Even as good as Thinkorswim, and I was blown away by the platform. But what's cool is they have a subscription-based model for commissions. So for those who trade hundreds and hundreds and hundreds or thousands of contracts, you know that your commissions will stack up like crazy. And so they've got a model that says, yeah, for $80 a month, you can trade infinite contracts. I'm like, holy mackerel, how does that? Mm-hmm. Can you come on and talk more about that? But also can you talk about your option trading and things like that? We got tax planning in retirement. We've got a cryptocurrency section. Merlin, I'd love for you to come on and do a cryptocurrency section at one point.
I would love to. I have a little bit of a employment conflict there, so until I can work that out, I'll do the show. That's as close as I can get.
Understood. I'm not going to stop bugging you though, Merlin.
Please keep bugging me. I would love to come on. Anytime I can talk markets, especially cryptos, I'm happy.
Yeah. So we've got a full day plan tomorrow. So just if you register, it's free. We are going to record it. The benefit of being there live throughout the day, and you can come and go, right? Some people stick around for a little while, come in over the lunch break, but the benefit of being there is you get to interact with all of us at some point throughout the day.
Yeah.
And at the end of the day, we're going to do a happy hour roundtable. It's just an open Q&A. We're going to pour some cocktails and talk for about an hour, answer questions. We usually get a pretty great response, a few hundred people coming in and out throughout the day. Purely educational. It's not a, as we call it, it's not a sales pitch event. Nobody's selling anything. It's just we like to do these to give back to the community as much as we can. It starts at 8 a.m. Central, so for those of us in California, that's 6 a.m. in the morning. And it'll go till about between 1 and 1:30 Pacific. So it'll go, it'll go all day. And we've got 6 or 7 presenters, I think.
Yeah. I'll read them here. You guys might be able to see it. There's a whole schedule if you click that link I was showing you. But you've got, I love the name, Kevin Lex Lutheringhouse, talking about GME short squeeze. Corey Lane will be talking about trade building, business plan. Ryan James Miller, how to control money game. Justin Krebs talking taxes. German Castles talking cryptos. You got Chuck and Corey as well starting off, and James Cagney of Infinity Futures. So a pretty busy day there. Last one here. Is it going to be recorded?
Yeah. It's going to be recorded. We record everything we do at TradersArmy. So no matter if you miss it, you miss a certain section, you want to review it, and then I'll send out instructions on the day after the summit, or when I have everything posted from the summit on the site. I'll send out, where can I find this recording, and then what you have to do to go watch it. But it'll be, you can access the whole summit for free. You can access the recordings for free. We just ask that you register so we know how many people are planning to attend, because we need to we might need to increase our Zoom room capacity.
Good problem to have. Good problem to have.
We can have up to 1,000 people, and but we have plenty of room. So come on in throughout the day. It'll be fun.
Awesome. Well, Corey, thank you so much for coming on and helping us with the Gamma Squeeze. I appreciate it, and I hope you guys have a great session tomorrow. Love it, man. Thank you. Thanks for having me on. It's always a pleasure, man. It is. Our once a month annual meetup with you. It's great. I love it. Awesome. When are we going to do this on the beach one of these days? When are we going to get a table out? Go hang out in your neck of the woods. You don't tempt me with a good time. Let me know when. I'm good. Let's do it. All right. Sounds good, Corey. Talk to you later, my friend. Thank you. All right. Be well, guys. Yep. Talk soon. Guys, that was Corey Lane of TradersArmy, giving us some insights into Gamma Squeeze, also talking a bit about their upcoming event, which is going to be tomorrow. Alan giving me a hard time. Yeah, I used to trade the open all the time. I hate mornings. I'm a nocturnal person, which is why I love crypto. I love Forex. I love futures because I'm a nocturnal person. I don't like mornings. I still get up, but 6 o'clock is just, God, I remember back in my old day trading days, it was just such a grueling process. I worked night crew for a long time, 10 at night till 6:30 in the morning, so my clock is all messed up, and it's been that way ever since. So, not a fan of trading the open, but that's why we love 24-hour asset classes. Let's see. To get to that, I mentioned just go to TradersArmy.com and you'll get the full rundown on their event tomorrow, and of course, any information you want more from Corey Lane and others. Let's go to your calendar for tomorrow. I'm going to try to get these shows a little bit shorter. I've been going long, and I got so much stuff to do. Here is your economic calendar for tomorrow. Now, you have a Euro unemployment rate number coming out. That's expected to stay at 8.3%, but a bulk of the activity is going to happen, of course, just before the U.S. equity markets open. You have unemployment claims, which are expected to spike up here just a little bit over the previous month. You also have unit labor costs, productivity, and then once the markets open, you have factory orders and natural gas storage, and then Fed Chairman Powell will be speaking right at 9:05. Yes, 9:05. Be careful there because that could be a little bit of a wild ride there in the during the trading session. Factory orders also coming out for Germany, but that will be late tomorrow night. Now, earnings front. It's been a kind of a weird earnings day today. There was, what was it? It was Splunk today came out with earnings like 3,000% higher than expected. It's pretty awesome. Tomorrow you have got Broadcom, Costco, Sienna, Kroger, and Burlington stores reporting earnings tomorrow. Of course, Costco probably going to do pretty darn good. Every time I go there, it seems like there's a bigger line than ever. It's nuts. So that is your economic and earnings calendar for tomorrow's trading session. Now tomorrow we have an interesting show. I wrote it down over here. Now I mentioned one of the things I like about the markets, there's always seems like something new coming up and new markets, new exchanges. Of course, the excitement with crypto is obviously one of the major things going on. But there's also products that the CME put out, which are these, you've got mini S&Ps and then you have micro for specific markets that are micro contracts, which aren't really intended, in my opinion, for you to be making a ton of money, but it's a great way for you to try to get familiar with a specific asset class, how that instrument works. And Tom Sosnoff and his group, I'm sure there's a bunch of other people that I should be mentioning in this, but started a thing called the Small Exchange. And I believe it's part of Tastyworks. So tomorrow I'm going to bring on Frank Caberna. He's going to talk to us about the Small Exchange, what it is, how it works, why it's critical, and I think why it's important to retail investors and traders to look at a market like this or an exchange like this because of the efficiencies of it. So it's something that's just kind of starting off. It's a very cool piece for me. I think it'll be a great show tomorrow. So check out Small Exchange. If you have any questions, feel free to send those on in. As you guys know, you can always go out there and send me emails at TraderMerlin@gmail.com, as many of you have done. So I appreciate all that. That said, that will do it for today's show. I'm going to wrap it up. Here we go. Set up a YouTube channel. Brandon, yeah, there you go. Do it, Brandon. Get your own get your own show. I can interview you on my show talking about the cash flow with cryptos and commodity metals. All right, that's going to do it for me for today. Again, that will be the show for tomorrow, which is going to be the Small Exchange with Frank Caberna. Feel free to send in comments, questions, feedback. If you are new to the program, hit that subscribe button. If you like the show, hit the like. Check out Corey's TradersArmy website to find out more information about their summit tomorrow, and I will see you guys tomorrow as well. Take care. Bye.